Why is fiscal policy key to understanding past inflation? Have you ever wondered why fiscal policy plays such a big role in understanding inflation? Let's break it down in a way that makes sense. Fiscal policy refers to how governments manage their spending and taxation. This management directly impacts the overall demand in the economy. When governments decide to spend more or cut taxes, they can create budget deficits. These deficits can lead to increased demand, which often pushes prices higher, resulting in inflation. Historically, we see that times of high inflation often align with expansionary fiscal policies. For instance, during wars or economic crises, governments usually ramp up spending. If this spending is not matched by an increase in supply, inflation can occur. A clear example of this is the post-pandemic period. Governments introduced large fiscal stimulus packages to support households and businesses. This surge in demand, combined with supply chain disruptions, contributed to rising prices. Now, let's consider how fiscal policy interacts with monetary policy. If a government runs large deficits without a credible plan for future surpluses, it can lead to a lack of confidence in government debt. This situation can cause interest rates to rise, which adds more inflationary pressure. The state of the economy also matters. When the economy is near full capacity, expansionary fiscal policy can have a stronger inflationary effect. This is because additional demand cannot be met by increased production. During these times, managing fiscal deficits becomes even more important. Understanding the relationship between fiscal policy and inflation is essential. If fiscal policy is not aligned with monetary policy, controlling inflation can become challenging. For example, if a government continues to run large deficits, monetary authorities may struggle to raise interest rates without causing financial instability. Lessons from past inflation episodes show that managing fiscal deficits and ensuring sustainable debt levels are key to controlling inflation. Policymakers need to balance supporting economic growth while keeping inflation in check, especially during recovery phases after recessions or economic shocks. In summary, fiscal policy shapes the demand side of the economy and influences inflation through government spending, taxation, and debt management. Its effects vary based on economic conditions, making it a fundamental factor in understanding past inflation trends.